Hi, and welcome to this video about ratio analysis for liquidity ratios. I'm 𝗏𝗏𝗃𝗏, founder of Maxwell CPA Review. So the liquidity ratios include the current ratio and the quick ratio. It's all about looking at our working capital and how capable we are paying our debts over the short term. And this video is a small part of a mini video course that I have all about ratios, how we analyze them. It includes practice questions as well. So if you're interested in that, you can check it out at the link below. And with that, let's jump into the video. So now let's jump into our first section of ratios, the liquidity ratios. These liquidity ratios are some of the most tested ratios on the exam. So in this video, some of the ratios are going to have multiple decimal places, but for simplicity's sake, I'm just going to round it to one decimal place. So for liquidity, there's a big emphasis on current assets and current liabilities. Current means that it's going to happen within a year. So current assets means assets that are going to be converted into cash within 1 year. So the following are current assets: cash and cash equivalents, marketable securities like stocks or bonds that you plan to sell within the next year, accounts receivable, prepaid expenses, and inventory. And within this list, the most liquid current asset is cash, because liquid means you're able to convert it into cash, and cash is already cash. The least liquid current assets here are prepaid expenses and inventory. Because for inventory, we have to first create the inventory, sell the good, and collect the cash. So it's not very liquid. And an important measure of liquidity is called working capital. Working capital is simply current assets minus current liabilities. So it answers the question, how much money will we have left over after we pay our current liabilities? For example, let's say that your cash is $5,000, your AR is $10,000, $0 in marketable securities, and $7,000 of inventory. So your total current assets are $22,000. So then let's say that your current liabilities are $10,000. So it means that in the next year, your current assets of $22,000 are going to become cash. Then with that $22,000 of cash, you're going to pay for your $10,000 of current liabilities. So the next kind of ratio is called the current ratio, which is current assets divided by current liabilities. So this ratio is trying to answer how many more current assets do you have compared to current liabilities? In other words, for every $1 of current liabilities, how many dollars of current assets do you have? So we mentioned earlier how prepaid expenses and inventory are not very liquid current assets. So that's why we have something called the quick ratio. So the quick ratio is only going to focus on the most liquid current assets, which are cash, AR, and marketable securities. So the quick ratio is going to divide those three by the current liabilities, instead of what the current ratio did when it added all of the current assets to the numerator. So if we calculate the quick ratio with our numbers, we would have cash of $10,000, AR of $5,000, numerator is $15,000. Our current liabilities are still $12,000. So our quick ratio is 1.3, meaning that we have 1.3 times more quick current assets, liquid current assets, than current liabilities. In other words, for every $1 of current liabilities, we have $1.30 of highly liquid current assets. So far, we've just been taking numbers from the balance sheet for our ratios, but this next ratio is going to take a number from our statement of cash flows. This is called the operating cash flow ratio. So our numerator is going to be the cash flow from operations, which is simply how much our cash increased or decreased from this year of operations. And then for the denominator, we just have current liabilities, just like we've had for these other ratios. So let's say that we had net credit sales of $102,000, but some of that was AR, so we didn't collect it in cash. Let's say we collected a total of $80,000 in cash. So that's our cash from operations. So then we divide that $80,000 by $12,000, our current liabilities. So 6.7 is our operating cash flow ratio, which means that we made enough cash in our operations to pay for our current liabilities 6.7 times. So it shows that we're very capable of paying off the current liabilities. So there you have it. I hope that you've learned something new in this video. And if you're preparing for the CPA exams and you want some free weekly content, I'm sending out a free weekly email with CPA tips and articles. So you can just sign up for that at the link below. Thanks for checking out this video.